following is a paid program. The opinions expressed are not necessarily those of WNBU and Interbanks Media. Welcome to All Things Money with David Blain, a thoughtful and revealing discussion of actionable ideas and effective strategies to help you through the complex world of investing, taxes, and real estate. Now, with All Things Money, here's David Blain.
Hello and welcome to All Things Money. I'm your host, David Blain. Thank you for joining us today on 94.1 FM WNBU, as well as Cable TV 10 in New Bern. Some of you may be streaming us from our website, www.dlblain.com. We welcome you as well. We've got a good show lined up for you here today. As you all know from listening to the news, we have sequestration right around the corner with March 1st. We'll talk a little bit about that, try to stay out of the political arena too much, but talk a little bit about how this is a good lesson for people if you happen to be one of the folks that unfortunately may get furloughed. Talk about how to deal with that a little bit. Talk a little bit about some things in the hedge fund world and some other topics. So we're glad that you joined us today. As always, if you have any comments or questions for the show, our number is 252-633-0107. The email to the show is allthingsmoney@dlblain.com. And you can always go to the website, dlblain.com, the big contact us button there. Dealing with a little bit of a head cold today, so you have to apologize if it doesn't sound like me. It is me, David Blain, here talking to you today. So let's get started with an article that was in the Wall Street Journal. This was back in January, but it has a couple of lessons contained in one article, and the headline is, Yusko out as investment chief at endowment fund. And for those of you that aren't from North Carolina, or even if you are, maybe you don't realize this, but Mark Yusko was the former head of the endowment fund at the University of North Carolina at Chapel Hill. And he did a good job for a number of years and left that position. I forget exactly the year, but he left that position and started a money management firm, or was with a money management firm called Morgan Creek, and started a endowment fund, a $3 billion hedge fund endowment fund with Salient Partners. So he moved from running Chapel Hill's investment endowment. He moved out, started his own thing, with all these hedge funds and moving out in the world. There are a lot of names involved, and so he partnered with Salient Partners and had the endowment fund in Morgan Creek. So there's a lot of players involved, but suffice to say, he moved into the hedge fund world. And with a company called Morgan Creek. And the article here tells that he has struggled with disappointing returns, and the fund told investors that withdrawals had exceeded the net inflows, and that they notified that they would get back about 5% of their money during the first quarter. And so investors were redeeming shares in the hedge fund, and so basically he's leaving as head of this endowment fund. And so the points that I wanted to bring up here, number one was, we see this a lot as chasing the star performer. Okay, so this man did a fine job as head of the endowment at the university, and when he left, a lot of people poured money into his hedge fund. Well, the returns have been extremely disappointing. For example, through last year. Now, hedge funds is one of the things I don't like about them. Their reporting is always well behind. They're at least a month or two behind in their performance reporting. So these numbers are through August of 2012. The fund had gained 1.7% compared to 13.5%. And over the 5-year time period, it lost 0.6% of investors' money. So suffice to say, it did an awful job. And so one of the dangers we see a lot of times is people chasing these star performers. He did a good job at the endowment fund. He moved out in the hedge fund world, and so people flooded him with money thinking that he was some sort of star. And as you've heard many times on the show, there are certain basic principles of investing, and we don't really ascribe to the star performer. In fact, the star performer, I would say, is, promoting our own firm, is a firm that realizes that there are limitations in the investing world, and that the people that tend to do the best are people that don't think they're smarter than everyone else. You know, there's a certain element of truth to the saying that the smartest people are the people that know how little they know. And that certainly applies in the investment world, that some of the more flamboyant managers and people with overconfidence end up blowing up quite often. So that was the first thing. Don't chase the star performers. There's no information, there's no study out there that leads you to conclude that anyone has the secret to investing over long periods of time unless they're following basic principles. What I'm talking about is someone that promotes that they can do much, much better than the market. Number two is we've warned people about hedge funds consistently. Hedge funds invest in the exact same thing that other people can invest in. There's only so many things you can invest in. You can invest in the equity of companies called stock. You can invest in the debt of companies as well as governments, you know, called bonds. You can invest in real estate investment trusts, which own properties, and really that's investing in real estate. You can invest in commodities such as gold or silver or oil, things like that. Or you can own currency, you know, US dollar, Japanese yen, things like that. Beyond that, everything else really becomes a derivative or a trading strategy. For example, you can buy these type of things on margin with leverage, so you can borrow to invest. You can buy options, you can buy futures, you can buy different things, but there's only a certain number of things that you can invest in. It's always, even a private investment, it's either ownership in some sort of operating entity that promises you a return based on the growth of that entity and any cash that it may flow off, or you're investing in some sort of debt. And so all hedge funds do is they invest in a different manner, but they invest in the same things. So you have to be cautious with that. They have low levels of liquidity. Excuse me. Low levels of liquidity. You can't always get your money back when you want it. The fees are usually very high. So the other illustrative point that I wanted to point out about this article was the endowment model, the let's all be like Harvard model that became so popular the past few years, where Harvard was known for doing extremely well in the investing world. Their endowment fund, they have a whole staff of people, and they were investing in things like timber and all these hedge funds, and they essentially were starting hedge funds, and so they had access to tons of capital, and they were able to do very well. And a lot of the reason was they were the only people operating in that space at the time. They ran the stuff in-house with their own in-house experts, and so a lot of people looked at that and they said, oh, well, let's just duplicate that, and they tried to duplicate it with less expertise, with less money, more fees, et cetera, and the results have just been kind of dismal. So we don't want you to necessarily try to copy other people. We're coming to our first break. When we come back, we'll wrap up and kind of summarize the salient points that I want you to get out of this article. So for All Things Money, I'm David Blain.